Your Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome. You're watching Financial Planner. Today we'll be talking about a very simple subject, but of course a lot more detail and emphasis on importance of savings account, the various options available when you're looking at liquid investment options out there. To talk about that, we've got Hemant Rustagi joining us in the studios. Hemant, very, very simple subject, savings account. Across the board, this is probably one instrument that most of us use. What is the importance of a savings account? What are the factors one needs to watch out for when looking at a savings account? And then, of course, we'll talk about the types of accounts available.
Oh, yes. I mean, as you rightly said, almost every one of us have a savings account. In fact, many of us have more
often than not, right?
Many of us have actually more than one savings account. So I would say savings account is the most common operating account used by individuals and others to actually make non-business payments. It's an account which helps us in terms of putting through our day-to-day banking transaction, like paying our bills, getting our salary, paying our housing loan EMI. So I think over the years we've seen a savings bank account being used to put through day-to-day transaction. And the good thing about it is that while you do that, you also earn some interest on the money which is lying in the account. So I think it's a very, very important account. Unfortunately, over the years, people have been using it for dumping all the money that they have, thinking that, it equates with making an investment. They feel that if they put the money aside in the savings bank account, they have actually invested their money. It's very important for them to understand that the money which is lying in the savings bank account generally should be the money which you use for your liquidity purposes, not putting your investment in that. So, and today, it actually has changed over the years. Today, you have so many facilities when you talk about a savings bank account. You can withdraw the money through ATM, you can do internet banking, you have phone banking. So I think a lot of facilities have come actually as far as the savings bank account is concerned. And in fact, I would say the last 1 year has been quite eventful for a savings bank account. I think it all began with May last year. It's when the RBI changed the method of actually calculating interest on the savings bank account. Now, what was happening prior to that was, an account holder was getting interest on the lowest balance between 10th and the last day of the month. Now, let me explain that by example. If somebody maintained a balance of 1 lakh rupees in savings bank account, and in the last day, if 90,000 was withdrawn, the balance would be 10,000. So he would get interest only on 10,000 for the entire month. In May last year, RBI changed that. Today, every account holder gets interest on his daily account balance. So I think that's a major change which happened. The second thing that happened in the savings bank account is last year again in October, when RBI deregulated savings bank interest rates. Now, what it means is the banks can decide on their own as to how much interest they want to give on the savings bank account. Immediately, we saw some of the banks started offering 5.5%, some banks offering 6%, and there's a bank which is offering 7% today.
So the range is 5%.
So imagine from 4%, it has come to 6 and 7%. Of course, not everyone is getting 6 to 7%. There are most public sector banks are still giving 4%. And of course, it doesn't make sense also to change your bank just because you're going to get 2% more for savings bank account. But the fact is, this is a major change that has happened. And the third major change that is going to happen, or in fact is going to happen now, is in the Union Budget 2012, the Finance Minister has made a provision that an interest income of up to 10,000 rupees from a savings bank account is going to be exempt from tax, which means that anyone who is earning interest up to 10,000 rupees from a savings bank account will not be required to pay tax. So you see, a lot has happened in the last 1 year. I think the utility of this account over the last 1 year has increased a lot. The only thing is people need to realize how much money they need to keep it in the savings bank account, because putting too much money into that also means that you're losing opportunity elsewhere.
So basically, for a normal salaried employee, you can have one salary account and a savings account. Salaried account obviously is where you get your salary. Savings account is probably a liquid contingency fund that you'd keep there. 6 months of household expenses ideally is what you'd look at.
Yes, I mean there can be other options there. I mean, we talked about creating an emergency fund. And if, let's say, if 6 months expenses turn out to be some 4 or 5 lakhs, it doesn't make sense.
Money into more cash.
Even if I go by the provision of Union Budget 2012, assuming that you're earning 4%, up to 2.5 lakh, whatever interest you earn is going to be tax-free. Beyond that, I think it's very important that you need to look elsewhere.
Right. Also, Hemant, we've talked about savings account. What about fixed deposits and recurring deposit accounts? If you can just throw some light on that as well. Again, very common instruments of savings and investments for people.
Oh yes, very, very common. Look at fixed deposit. As the name suggests, it's a deposit which you do for a fixed period.
Right.
Now what happens is, because you commit to keep the money for a fixed period, the bank tells you upfront as to how much interest you're going to get. This is generally in line with the interest rate scenario.
Right.
There are times when you get very high interest, there are times when you don't get a very high interest. Because you commit, like I said, you know exactly how much you're going to get, and you have to commit to keep that money for that period.
So there's a lock-in period.
Good thing about that is there is a liquidity in the sense that if you need the money, you can go back to the bank and withdraw your money. Of course, the bank is going to levy some penalty. What typically happens is that if you have a 1-year FD, and if you take out your money after 6 months, they will apply the interest rate of 6 months and maybe levy a penalty of 1% on that. The only thing is that being a traditional investment option, it is not very tax efficient, especially for the depositor in the higher tax bracket of 20% and 30%. As far as the recurring deposit is concerned, it's again an account where it's like a fixed deposit, but you don't put a lump sum money in that. What you do is you give a standing instruction to your bank saying this much money should be transferred from a savings bank account to a recurring deposit account. The whole idea is because savings bank account does not give you very high interest.
So if you've got that 2.5 lakh gap, you could actually use a recurring deposit account.
Either a recurring deposit. If let's say you're in the process of creating your emergency fund, for example, you don't have a lump sum. Now you don't want that money lying beyond a certain amount in the savings bank account. So you can ask the bank to transfer that to a recurring deposit account. Of being by nature of a fixed deposit, you get higher interest in that, and it also helps you in accumulating some amount over a period of time.
A lot of times, Hemant, you assume that if you've got high risk, high return, there's always a lock-in period. There's not that much liquidity available. But I think flexi deposit, can you talk a little bit more about flexi deposit? What is this all about? Because I believe your pointer says that it offers liquidity and gives good returns as well. So what is it about flexi deposit that's so attractive?
Well, I think it's a wonderful thing actually to have. What happens here is, like we talked about, if the money is lying in savings bank account, you don't earn that much interest. So what you're trying to do here is to try and earn more interest without compromising on the liquidity. Because we talked about, let's say we talk about, again about the emergency fund. The key factor is that money should be available to you at any point of time. In the flexi deposit, what happens is you set up a system with the bank saying every month you transfer X amount from a savings bank account to a flexi deposit. It's like a fixed deposit. Why it's called flexi deposit? Because if a certain amount is going into the deposit.
What's the difference between a flexi deposit and recurring deposit account?
In recurring deposit, the money goes there, and it doesn't come back to a savings account in case you need that money for a certain period. So it's very different. So like I said, if you set up a flexi deposit saying that 5,000 rupees should go from a savings bank account into a flexi deposit every month, the bank will do that. Suppose you set it up on 1st of January 2012 for next 1 year. Every month 5,000 will go. At the end of the year, you'll have 60,000. Now the advantage there is, while you are earning higher rate of interest, you do not compromise on your liquidity. Because what happens? Suppose you have a balance of 10,000 in your savings bank account, and there's a payment which is going to hit your account of 15,000 rupees or 13,000 rupees. Now you don't have to worry about that. Because you have opted for a flexi deposit, the bank will take out money from the deposit, and generally it is the last in, first out. So what happens? The latest deposit will be broken, amount will be taken out. Suppose a 5,000 unit, 3,000 is taken out, put back into the savings bank account, the payment is honored, and the remaining 2,000 of that deposit and the earlier deposit continue to earn higher rate of interest. So you see, you give yourself a chance to earn higher rate of interest without compromising on liquidity.
So flexibility, like the name suggests, tells you the key benefit of a flexi deposit.
It is very important.
Right, Hemant, what about the auto sweep-in facility? I'm guessing this is the right opposite of a flexi deposit account.
Yes, it is. It works in a completely different manner. You see, what happens is every bank has stipulated how much money you need to keep in the savings bank account. An investor can also, or a depositor can also decide how much money he wants to keep in a savings bank account. Obviously, this limit that he sets for himself has to be more than the limit which is stipulated by the bank. For example, the bank says minimum balance you have to maintain is 10,000 rupees, and if I decide I want to keep 20,000, so it has to be more than what the bank has stipulated. Beyond that, you give instruction to the bank that once the balance crosses that threshold that I've set, it's transferred the money to a fixed deposit. Obviously, it's done in a multiple of 1,000 or 5,000, whatever the bank will decide. So every time you have an excess of 5,000, the money will be transferred to a fixed deposit. That part works like a flexi debt. Then if the money is required in your savings bank account for honoring a particular payment, the money is taken out from the deposit, transferred back to the your savings bank account. So that's the only difference. There, like, you decide how much money has to go. There, in the auto sweep, once it crosses that balance which you have set for yourself, the money automatically goes transferred.
Yeah, Hemant, if I had to ask you, you have both of these flexi deposit and auto sweeping facility. There's never a free lunch. I'm guessing there must be some sort of charges. If there's no penalty and if there's liquidity available as and when you want it, how does it work? I mean, how does the bank sort of deal with a client like that?
Well, I think,
is there an is there a charge? Is there an expense?
There is. Some of the banks are charging, some of the banks are not charging. Okay. I think one has to be very careful before you set up either a flexi deposit or auto sweep facility. Right. I think find out what the charges are going to be. So it's some of the banks may charge, as we talked about earlier, that there may be a levy penalty of maybe around 1% or so, and that also on the interest rate applicable for the period for which your money has remained in your deposit account. So I think find out how much it is. And second thing is that if someone is going to use a savings bank account for a lot of transaction, I think it doesn't make sense to then go for a flexi deposit or auto sweep. So I think these are two factors one has to really keep in mind.
Those are, of course, details about a savings account and the different sort of liquid funds that you could possibly consider. We'll take a break on that note. We'll come back and take up all your financial planning queries, so stay with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF. The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome. You're watching Financial Planner.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a very interesting query from somebody who's very honest. Ganesh Iyer, I think, pretty much represents a very large part of the investment community. I'll just quickly read the query and then you can take it from there. He says he finds most of the time that stocks give superior returns, so he agrees with us on most things. But he also finds that mutual fund schemes have not been able to catch the performance delivered by stocks. He says he'd like to know what can be done with investments in stocks and should he continue an SIP for at least 3 years. He also says he's barely doing any investments in commodities. Would it be wise to invest in commodities through the exchanges or can he buy them in physical form? He's looking to know if it's a good time to buy gold as an investment opportunity for a span of 10 years. And he also says, please send me a reply soon because he's very confused.
Well, first thing I would like to tell Ganesh is that he needs to understand that equity as an asset class has the potential to give you very good results over a longer period. But at the same time, you have to contend with some kind of volatility during medium term and short term. There are two different ways that one can invest in equity. One is to go and invest directly into the stock market, buy stocks yourself. The second is, opt for a diversified investment vehicle like a mutual fund. Now, what typically happens is that, as he said, that sometimes he feels that the stock portfolio is giving better return. When you invest in stock, you tend to have a concentrated portfolio. Maybe you have 10 or 15 stocks, and if you have done well in terms of stock selection, the chances are in a rising market, the stock portfolio will do better than a diversified investment vehicle like mutual fund. So at the same time, the moment the market turns volatile or the market starts going down, you will see much more fall in this portfolio, and also the volatility level is going to be much higher. On the other hand, when you talk about mutual funds, you hand over your money to the professionals who manage it. And they are more diversified in more than one ways. One is that with a small sum of money, you get a diversified portfolio. The second is like there are thousands of other investors who keep investing in that. So being a diversified vehicle, if you really compare the performance of mutual funds over a period of time, they have actually, the good quality funds have outperformed the benchmark. Okay, so they have done better than the market. But when you compare with the stock portfolio, the chances are that in a good market, when the markets are going up, they may underperform a stock portfolio, but they will give you higher protection in terms of when the market goes down.
I think they always catch up, and the longer the time horizon, the mutual fund performance will catch up with what a stock does to get that volatility.
Absolutely, because the thing is that a stock portfolio will require you to make a lot of changes in that. And if you don't have the wherewithal to actually manage the stock portfolio, you may continue with some of the stocks which should not be there in the portfolio. Whereas when you go through a mutual fund, you have mutual fund managers who take decision on your behalf. sometimes you don't even realize what changes have happened in the portfolio. So I think I think that makes a difference. So I think there are going to be time periods where you will see, and I believe that it's not that you have to have either stock or mutual fund in a portfolio. Both can complement each other depending on how much money and how much risk you're willing to take. Second thing is doing SIP for 3 years. I don't think that's the right time horizon. I believe that someone who wants to invest through SIP, because you're accumulating money over a period of time, you must have a time horizon of 8-10 years or even more. I think equity as an asset class works out well over a longer period. The more time you give your money, the better it is for your portfolio. And also from the power of compounding point of view, it works very well. As for gold is concerned, gold has a place in every portfolio. I don't think one should look at whether the price today, with the current price, I should start investing or not. See, the purpose of investing in a gold could be that you want to accumulate gold for a specific purpose. For example, accumulate gold for a child marriage, or try to gift to someone in the family, or doing a part of asset allocation. Like we generally believe that 10 to 15% of the portfolio can go into gold. So if you're doing it for any of these purposes and planning to invest over a period of time in a systematic manner, I don't think one should really worry too much about the current prices. Start the process, continue the process, and keep your focus on what goal you want to achieve through your gold investment.
Right. Ganesh, that's the advice coming in for you. We'll take a break. We'll come back and take up more queries of yours in Financial Planner.
The Financial Planner, presented by the Bombay Stock Exchange, IPF. The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. Hemant, we've got a query coming in from a senior citizen. He says that he's retired from a large PSU company and his annual package was about 24 lakhs taxable. He will turn 64 and will not like to serve anymore. His children are well settled and he and his wife stay in their own home. Their medical needs are taken care by a scheme fully, for which he pays about 2,500 per year. Their monthly expenses are about 50,000 rupees. At present, these are the following investments. He's got Post Office Senior Citizen Scheme, Post Office Monthly Payment Deposit, Bank FD for 2 years, 1 year, savings account of 5 lakhs, mutual fund debt-oriented funds of 4 lakhs, and mutual fund small and mid-cap funds that he's invested in for 4 lakh rupees. What's your take on his portfolio and what he should be doing?
I think the first important thing is that, as he rightly said, his medical expenses are being taken care of. It's very, very important at that age, because the medical expenses tend to go, very high at that stage. So I think that is something which is very, very positive. If I, look at this entire portfolio and the interest income that is earning, plus the capital appreciation from some of his investment in debt fund and equity-oriented fund, he can expect to earn something around 7.5 lakh rupees. What is requirement for annual expenses around 6 lakh rupees. So he'll have a additional income of around 1.5 lakh, which works out very well for him as of today, because that he can keep aside as an emergency fund or also add back to portfolio kitty. So as of now, I don't see much of a problem, but I think going forward he will have inflation to contend with, and I think there can be a situation after 3 or 4, 5 years where he may have problem in terms of managing his money. So I think a couple of changes that he can make. One is that his FDs are for a year or two. Wherever, I think what he needs to do is, if he's getting good rate of interest, he should lock in for slightly longer time, some part of it.
And it's quite a large sum of money.
Yeah, do not compromise too much on liquidity, but I think make sure that some part of it is invested there. The second is he can also consider fixed maturity plans on mutual funds, even though I don't think the tax efficiency is a big issue for him. But I believe that at current stage, FMPs are very attractive, so he can look at that. The only problem there is that he will not be getting interest regularly as he gets from the fixed deposit, because if he's doing 1 year FMP or 2 year FMP, the entire money will come at the end of the period. Because he has a cushion of 1.5 lakh extra income, he can compromise on that. So he should go in for that. And maybe I would like him to add another 5 or 10% of his portfolio in equity-oriented balance fund. Like I said, he needs to start preparing to fight inflation. And that problem will come to him maybe around 3 or 4 years from now. As of today, he has enough cushion margin to take care of his monthly expenses. These two changes, if he does, he won't be compromising on liquidity. He will get better return and will be tax efficient.
Investment Ladder, presented by BSC, Investors Protection Fund.
Right, so there you go. That's your advice coming in. You've retired and Hemant has advised a couple of changes that you can make in your portfolio. That's all the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by the Bombay Stock Exchange.